Hi, we are LF02 Team 6 and our case study is Wingtai Holdings Limited. Wingtai was founded in 1955 in Hong Kong and incorporated in Singapore in 1963. Its core businesses are property investment and development, lifestyle retail, and hospitality management in Asian markets. Wingtai's primary activities include property, hospitality, and retail. The Wingtai Group does property development and investment in both residential and commercial properties in Singapore, Malaysia, Hong Kong, China, and Australia. In terms of financial performance, Wingtai saw an increase in total profit from $26 million in financial year 2017 to $221 million in financial year 2018, as revenue increased significantly due to sale of development properties, as well as the increase of share of profit associated with their joint venture activities, which saw an increment of $111 million in financial year 2018 compared to financial year 2017. One additional contribution factor to the profit increase was due to gains from various activities such as gain on disposal of subsidiary companies and fair value gain on investment properties. In the social performance aspect, Wingtai fulfills its corporate social responsibility through the Wingtai Foundation, which provides financial aid and donations to the needy. In 2017, Wingtai worked with the Wingtai Boys Brigade Share a Gift project and volunteered with the Food Bank Singapore to collect and sort food donations. The group also worked with Touch Community Service and spent an afternoon with the elderly at its senior activity centers. During financial year 2018, Wingtai provided financial support for the disadvantaged children and at-risk children through the Community Foundation of Singapore and MCYC Community Service Society respectively. Through Sing Health and Kidney Dialysis Foundation, Wingtai also provided funding for elderly needy patients, as well as contributing to the community chest and its beneficiaries. In addition, at the end of financial year 2018, Wingtai published its first ever sustainability report and will be publishing it annually going forward. The group hopes to use this report to share its commitment to sustainability with its valued stakeholders. Now I will pass it on to the next presenter.
The profit for financial year 2016 is at approximately 15.66 million. However, after factoring in the other income from the consolidated statement of comprehensive income, it has become a loss of 24.81 million. Going through the comprehensive income, we noticed that a huge portion of loss came from the currency translation difference. These currency translation difference are due to the subsidiary company having their statement prepared in another currency as compared to the parent company. During financial year 2017, the profit is at approximately 26.39 million. Our group looked at the currency translation difference which previously caused the losses of the company. At financial year 2017, the currency translation is positive at approximately 14 million. After factoring in the consolidated statement of comprehensive income, the total profit grew to approximately 43.94 million. Comparing financial year 2016 to financial year 2017, a loss of 24.81 million to a profit of 43.94 million, it is roughly an increase of 68 million. It was contributed largely by the currency translation difference. As for financial year 2018, the profit is at approximately 221 million. After factoring in the other comprehensive income, the profit is at 219 million. Such huge increment is due to the gain in gross profit. The gross profit is currently at 180 million as compared to 136 million in financial year 2017. Share of profits has also rise from 100 million in financial year 2017 to 211 million in financial year 2018, contributing over 100 million in profit. Also, other gains increased from 6 million to 32 million, which the other gains include a 12.6 million gain from fair value gains on investment properties, which did not happen in financial year 2017, as well as the gain on disposal of subsidiary companies, which is at 16.6 million. Comparing financial year 2017 to financial year 2018, financial year 2018 has a profit of approximately 221 million, which is a huge increase of roughly 195 million. As mentioned earlier on, there are one-time events such as the disposal of subsidiary companies which contributed to the increase of profit for financial year 2018, as well as recurring events that contributed to the profit and loss for the years, such as the currency translation differences, which happen whenever there are subsidiaries that prepare the statement in other currency that are different from the parent company. Thank you, and I will now pass on to the next speaker.
According to FRS 17, a lease is an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. In the current accounting standard, leases are being classified into two categories, either operating or finance leases. A finance lease will transfer all future risks and benefits of ownership to the lessor and recognize the lease as lease assets and lease liabilities in the balance sheet. An operating lease will mean that the risks and rewards of ownership still lies on the lessor and not the lessee. The lessee will recognize the lease as rent expense on the income statement. In the annual report for Wing Tai Holdings Limited, the company adopted the leases as an operating lease for both financial year 2017 and financial year 2018. The new accounting standard IFRS 16 will require all leases to be included in the balance sheet regardless of the types of leases agreement. However, this cost can be exempted if the lease is for a period of less than 12 months and is of a low value item. Then it is not required to be included in the balance sheet. By doing so, it will cause a great impact on the lessee as it will affect their financial ratios. When the company adopts the new accounting standard, the rental expenses on operating leases will be replaced with depreciation and interest expense. Due to the recognition of depreciation and interest expense, it will mean that the company will have higher operating profit. As the company is still adopting the old standards, the impact on profit will have to depend on the lease contract the company had entered and the tax rate. Thus, we are unable to provide a definite figure on the impact. The lease will be recognized as lease assets and lease liabilities in the balance sheet. This will cause an increase in the total assets and total liabilities. With higher asset base, the assets turnover rate will be affected. It will cause a decrease in the turnover rate due to the increase in total assets. On the other hand, when there's an increase in the total liabilities, the company will have higher financial liabilities. This will result in the financial leverage to increase. In conclusion, the new accounting standards will cause a substantial impact on the lessee because the company will have to recognize the leases in their balance sheet and account for the depreciation and interest expense. It will cause an increase in the total assets and total liabilities, and with the additional operating expenses, it will cause a fall in the profit. Thank you, and I will now pass on to the next speaker.
Under Wing Tai's Property, Plant and Equipment (PPE), there are 5 classes of properties and equipment such as motor vehicles, office equipment, furniture and fittings, freehold land and buildings, and leasehold land and buildings. Out of the 5 classes of PPE, only freehold and leasehold land and buildings are measured at fair value, while motor vehicles, office equipment, and furniture and fittings are measured at cost. From the annual report in financial year 2018, it is shown that there have been revaluations for the freehold and leasehold land and buildings. There is a revaluation gain of $918,000 and a revaluation adjustments of $1,094,000 under leasehold land and buildings. From note 20 of the disclosures, it showed that freehold and leasehold land and buildings are measured according to their revaluation value, while the rest of the PPE are measured at cost. At note 2.6a of financial year 2018, Wing Tai stated that there are measurement methods in recognizing the PPE. It stated that they employ external valuers at least once in every 3 years to revalue their land and buildings. As for the other PPE such as motor vehicles, office equipment and furniture and fittings are valued at the cost less accumulated depreciation and accumulated impairment losses. It is important for the information in financial statements to be true and fair to allow users of the financial statements to make informed decisions. If the information reported is material and misrepresented, it can result in misleading users and reflecting Wingtai as unreliable. As the motor vehicles, office equipment and furniture and fittings are equipments that depreciate in value over time due to wear and tear, their value will not appreciate. Thus, Wingtai prefers to measure the above assets by the cost model, as revaluing them will incur more costs and will be a waste of resources as it does not substantially affect the value of the assets. On the other hand, for freehold and leasehold land and buildings, their value can increase or decrease throughout the years from the initial purchase price. If the increase or decrease in value is substantial and material, it can result to misstatement and affect the value of the assets and the decisions of the users of Wingtai's financial statements. Hence, for land and buildings, the revaluation model is preferred by Wingtai to measure their current market value. Thank you.